Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name's Seth Krussman, and I'm joined here once again with Ben Brayshaw and Dan Mickelin. How are you guys doing today?
I'm doing good, Seth. How you doing, Dan?
I'm doing really good. Really good. Excited for the show. I think it's a good topic, and it's something that we talk about with a lot of people that we meet when we start talking about trends we see in the market. So I'm excited to get to it.
Dan's always excited about the show. He always thinks it's good. When are you going to say this show is going to stink? Don't turn off the radio. Don't listen.
That'll be my last show.
Okay, good. The next show after your last show.
That's right. My sign off.
Your sign off.
Yeah, there's a little truth to that joke there. Sometimes we have topics in here that we're like, you know what? Even as financial planners, we got to do it. But it's not our favorite topic. Or it's not our favorite show. However, what we do get excited about is you and the opportunity we have here at Money on Tap as financial planners with Brayshaw Financial Group. If you didn't know, that's what we do. But we're excited about that connection that we get with you and an opportunity to introduce something maybe you haven't heard about. Or maybe we're just deepening your access into what's important for you in financial planning. And it is a big topic and one that most people just kind of shy away from, and we get it because everybody's got their experience with money, and sometimes it can be a little bit overwhelming or intimidating to get in the room and sit down and do some financial planning. Well, we're going to grab some bite-sized pieces. We're going to grab some topics, and it just happens that today's show is it's a topic that we spend, I would say, a significant part of our time on. Last show we were talking about the CPI, and you know what, frankly, it was a great show. And it's not a topic that we're going to bring up and talk a whole bunch. But what we're talking about today is building and navigating generational prosperity. And man, even as I say that, that's just like, oof, that takes up a lot of space in this room today. And it's just critical and important, and we're passionate about that. We're passionate about building wealth for our clients and generational prosperity for not only their children, their children's children, but the organizations and the projects that they're passionate about. That's you. If that's you, yeah, give us a call. That's what we're here for. And stick around. The show's going to make a difference in your life today. So I'm excited too. All that to say, Ben, I'm excited too. I think this is going to be a great show.
Yeah, I do think it's a great show. I think it's really hard to absorb the fact that, the U.S. household assets are projected to increase from roughly $87 trillion today to $140 trillion. I'm not saying billion, I'm not saying million, I'm saying trillion by 2030. That was by the Deloitte Center for Financial Services. I think, that increase by 2030 is just, it is literally almost hard to even, you can't comprehend it, but it's just hard to think it's that large of a growth trajectory and all the craziness we're having. Our last show, we talked about the CPI and the Fed's still potentially raising rates and what's that going to look like and everything else. But, when you look at that massive time horizon of wealth growth and what that looks like, it's pretty astronomical. And navigating that is, and being a good steward about what God has, put in your life and what you're in charge of and handling, and that's a tall order, and it can get daunting and overwhelming for people, all the time.
It's amazing when you meet with people, and there's not a lot of people out there that necessarily have this kind of wealth today. There's a lot of people that we work with that have gifting in mind, and they're able to take care of the next generation in some ways. and we love helping people do that. And there's lots of different ways we can help them accomplish that. But when you have that opportunity to sit with somebody who's truly got enough wealth that they can, to Seth's point earlier in the open, they can take care of the next 2, 3, 4 generations of their family to come, presuming there's some good stewardship between here and there. I mean, anybody can blow a ton of money, but, it's just an unbelievable feeling and opportunity to set that kind of a thing up. And, the impact you can have on the people most important to you for a long time to come, it's really amazing. It's got to be an amazing spot to be in.
Yeah.
Hey, I can't wait to get into it with you guys, and we're going to get there in just a minute. But right now, it is time for Money in the News.
First up from Fortune, it's brought to us by Alicia Adamczyk. Americans' 401ks got slammed last year, Vanguard reveals, along with how much more money boomers have in the bank than everyone else. That's kind of a tie-in to one of the themes of the show is taking a look at that baby boomer generation. But this really applies to all of us. So the average retirement account balance fell by 20% compared to 2021 in the downswing from 2022. So that's a pretty significant dive across the board for all investors in retirement accounts at Vanguard. In 2021 closed with a record high of an average of $141,542 in each account, down to $112,572 last year. And the median balance fell from $35,345 to $27,376. And they further break it down by generation, and we're going to kind of dive into that, by various age groups. But the fact of the matter is anybody would probably presume if you were in the market in 21 that things were not great, and we saw all the major indexes take a bit of a fall. But when you're thinking about people's retirement accounts and how precious those are towards how they prepare for that phase of life, a 20% drop in a given year in those accounts is certainly substantial, and it's something that needs to be addressed with future planning. Thankfully this year has been good, and I bet a lot of those accounts have begun to rebound. But you really hope people didn't exit the market entirely out of fear, which we'll get into here in the article. There's some concern around a lot of people who do that.
Yeah, I mean, I think last year was an absolute catastrophe for a lot of people, and honestly, with 10, 20,000 people a day retiring in the baby boomer marketplace, I mean that's a lot of people going to cash or hitting that negative event in a market. It just sends fear through your bones. I think that's one of the things, setting up planning for people to really help them, create some sort of foundation around their retirement has been a long stay for us of what we do for people and trying to really, weather that. And that's become significantly easier with interest rate hikes. I mean, these interest rates, make fixed income planning significantly easier and much more attractive than kind of this weathering the storm of the market. But that being said, you're right, Dan. I mean, there's so many people have just sold out of the market. I mean, we were talking to some people the other day, and I was just thinking about how they just took an absolute bath last year, and they didn't sell, thank goodness. But the market hasn't fully recovered their value. That's the scary part. I mean, the market's doing well, and people aren't doing that. When you really think about your money, if the if you have $100,000 and the stock market goes down 10%, you have $90,000 after that loss, and then you need 10% of that for income, another $9,000 of the 90, you're left with $81,000. I mean, just to get back to square one after a big, huge hit. I mean, 10% is not the hit we had last year. It was a lot worse than that, right? 30% for some people, maybe even more. To go from $81,000 back to $100,000 is a 24% rate of return. That is a huge. I mean, how many times do you outperform the stock market's return by over 2x? I mean, it's, hedge fund managers hope to do that. So, at some point in time, you have to realize that compounded loss makes, down market years tremendously more difficult. And if you don't stay in and you don't have any recovery because you sold out because you were in fear, you just doubled down on that loss.
Yeah. One of the things that I did like seeing here was that despite the industry uncertainty, there is a higher contribution rate. And, for the most part, overall, women are contributing more than men. That's a statistic that stays and remains stable. But more so, what I love seeing here is that Vanguard's publishing that the report is 83% of the participants are contributing and at an average of 7.4%. So that's better and higher than we've seen in previous segments. Some of those were like December of 2017. Anyways, there was just a better participation rate. Overall, that's a healthy trend to see in this marketplace, and especially continuing to see those increases through periods of time of uncertainty. That's what we want to see overall as investors, or for our investors, to just stay invested and continue to increase those contributions, especially as they get older and they start to look, more towards those retirement years. So I was pleased to see that.
I thought it was interesting here too. It says only 3% of active participants in retirement plans there. So these are payroll deducted employer plans, but only 3% paused those contributions. So even though things were in a kind of a downward spiral, people more or less stayed true to form and continued their contributions, even though there's a lot of psychology would tell you that people will stop doing that. But, by and large, that tells you that people did exactly the right thing. When the market's in a downtrend and you're not yet retired, buy more, keep contributing, keep getting into that lower priced opportunity, knowing that you don't need those shares and those stocks until some date further out in the future.
I'd be curious if they could tease out a lot of these plans are doing auto increases in the contributions of roughly 1% a year, and how much of those increases were kind of created by that automated service, or if there was really, just people were plugging in the money on tap and actually listening to what we've been telling them to do.
Well, hopefully we're having that kind of effect on that kind of scale. That would be great news. But the thing about this recovery, just to hit one last point, so much of what's happened in the market so far this year has been driven by the mega cap tech world, right? And how many of these retirees and pre-retirees are actually in that part of the market? You hope they're still having some exposure to that, but in reality, a lot of this recovery has probably not been felt by that group of people.
Yeah, I think we've mentioned it a few times. The AI, I would call that the boomer trend right now. Like, not that boomers are buying it probably, but like your point, Dan, but that is forcing our market in the tech space to really, find its own new heights. It's been incredible what the Qs have done. The tech space has just absolutely skyrocketed. And I don't know if, I don't know that I can say that we have a coming down scenario just with all that's happening around AI, because it is changing the scope of technology. It's taking it to another level. So, and I think the introduction of AI takes something that's already tremendously addictive, the technology we live in, the phones, the iPads, the computers, whatever, all this stuff that is just so immersed in our life. When I see what AI does and I see how you can implement it, it's literally, I think it's literally like going to be attached to our skin. It is submerging itself in our bodies and our souls and our minds. Like, it is part of life. And we've joked around a zillion times over, right? What is tech? What do you own that isn't involved in technology? So there's a lot to be said and a lot of questions to be raised of, when does this end? So, yeah. And you're right, Dan. The boomers are not engaging in this expansion space.
Well, now that AI is building portfolios, AI is going to recommend you buy AI, isn't it?
I think so. It should be biased.
I would. Greg Bartalos of Barron Advisors, thank you so much for enlightening us on this travel surge to Europe. Isn't the only reason to invest there. So what's happened? Cooped up over COVID, right? People did a lot of domestic travel. Well, now it's gone international, and it's a huge demand. Actually, what was it? A couple of weeks ago, I think we were kind of talking about some travel stocks and some of the stuff that we've seen in recovery in some of these areas. And particularly, I think we were talking about airlines and some of the tickers on those airlines and how they've done so well. No, actually, it was cruise lines. That's what it was. Either way, travel is a big deal. And what we've seen is that, yes, those have gone up, but it's not necessarily supporting the Euro Stocks index. It's at about a 36% discount to the S&P 500. The idea here, big idea, was that, kind of a contrarian trade is that there's an opportunity here, right? U.S. has done fairly well, primarily because of, AI, as we've mentioned, and, that's been leading the trend here with us. But Europe has been a bit of a lagger. And so maybe with this, not only the travel happening, but China was a big part of this story as well. And money flowing in towards Europe, is that might be an opportunity as a trade.
Yeah, I know it says the travel expectations have increased 55%, right? People's willingness to go over there and ability to get there, post-COVID. So, it does seem like opportunities ripe. And, there has been, with the Fed moves, discounting of the dollar, which is making, exports from Europe a better opportunity for those manufacturers and builders there. So, taking a good look at Europe, considering its discount to the S&P 500 right now, it looks like this could be some returns.
Could be some opportunity there. Next up, we have Apple tests generative AI tools to rival OpenAI's and ChapChat and so forth. Yahoo Finance. This is, it's funny. We were just talking about this. I was just talking about this the other day, so you guys had to throw this in my face. This is a Reuters article. So Apple is in the background, according to a number of people reporting in, no names named, of course, that Apple is building their own AI called Ajax. And they're using this, large language models, the LLMs as they call them, and they're testing this, and some engineers are calling it the Apple GPT. It doesn't surprise me that they would build from the ground up, because that's what they do with almost everything, right? So it makes sense that they wouldn't. They're either going to buy you because they don't want to do it, or they're going to, do it themselves. I mean, that's pretty much their story. So I think it's interesting as we kind of dig through this, because, I mean, if someone's going to do this well, right? I mean, Apple's standards, I think it's going to rival pretty well. I mean, they've got the money, they've got the cash, they can hire everyone to do what they need to do. I don't think this thing is going to come up short-sighted if that's the case.
No, Apple doesn't tend to finish second in anything, right? So it seems like being deliberate and maybe intentionally so to get into this market space, but you'd have to presume that, when they do, that they'll make a significant splash. And, when this article hit, it actually drove the stock price to an all-time high. I'm not sure. It's probably receded a little bit since then. But, being the tech player that they've been for the last 30 years, you couldn't imagine that they're going to miss this boat entirely and not take a presence in this market. It's bound to happen.
Well, why not? Apple's pretty much set the record for, grabbing innovation and really pulling it through and teasing it into a different direction that really connects with the consumer better than everyone else. Am I wrong? I mean, we're all kind of in this AI boom in one way or another, but maybe we're not all out there using the Chat GPT model because maybe it just hasn't become, our personal assistant yet, and we haven't figured out how to do that. And I think that's where they're going with this, is how do they really get this personal assistant in the form of the AI. And that's one of the things I loved about it is, Apple doing it again. You guys, this is great stuff for us to probably pay attention to, if not today down the road. I know we're going to have lots of fun conversations actually behind the scenes on this stuff. And we can't wait to share all that information with you down the road. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about building and navigating generational prosperity today. And if you are a podcast subscriber, make sure to drop us a note and let us know, because we want to send you some Money on Tap gear. And if you're listening to us on the radio today, hey, all you got to do is open up the podcast, search Money on Tap, subscribe, send us a note. We're going to send you some fun stuff, and we can't wait to join you there. And we appreciate you all for being here today and joining us in this journey of building and navigating generational prosperity on Money on Tap.
Hello, everyone. This is Dan Mickle of Brayshaw Financial Group. Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Advisors are here to help. Our team of experts will provide you personalized advice tailored to your financial goals. Visit us at BrayshawFinancial.com today and schedule your free consultation. Brayshaw Financial, investing made easy.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. It is the show we've been talking about for a while, and it's building and navigating generational wealth. Really close to our hearts as planners. We are really passionate about working in this arena. And I think one of the things for us that why does this captivate or capture so much of what we're about at Brayshaw Financial Group and why we do Money on Tap is it really harnesses the big picture, and it brings all of the industry to a focal point. And that is the accumulation and then that distribution, and not only the distribution while you're in that retirement phase, but it's the needs of your family members while you're here, the needs of your family when you pass, the process that you choose to pass through. You know, that's a lot of the estate planning idea. And the transition of wealth, it's remarkable how oversought it is, or how underutilized it is. I think the statistic is there's only about 60% of the population that actually has anything in place, like in regards to a will, or and less than that when we start talking about some of the other tools and vehicles that people can really use to mitigate some of the taxes and allow for, you know, their desires to be carried through in this process. So it really is. It's not just, you know, we talk a lot about investing, and we talk a lot about, you know, risk management and using life insurance and, you know, all these parts and pieces of financial planning. But this is it. This is kind of the top of the mountain for us. And so this is going to be a lot of fun for us to get into with you today.
Yeah. Wow, Seth, that was a lot. I really appreciate that. That's a great perspective. And I think the idea of accumulating wealth, distributing wealth, and creating the transference of wealth is a very complicated process, right? We talk about it with quite ease. I mean, honestly, we're like, boom, 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 this is what you do. But the truth is that going through each of one of those and doing them well requires a lot of, you know, kind of linking pieces together. You know, I remember those, you know, the chains, you know, the paper chains you'd make as a kid, and you hang them on the Christmas tree, you create your own links, and you're like, oh, this is really neat. And when you can link all of your investments together, and you can bring it together to the point where you're building the right, you know, legal document mix and owning the right assets and creating the right transfer, you know, mitigating, you know, taxes and distribution and how the kids get it, and, you know, if there's a special needs issue, and the building and navigating of, you know, generational wealth. You know, you don't need to be super wealthy to be listening to the show. This is about everyone. Whether you have $10 or $10 million, you have wealth, right? You are a fortunate person to have money put aside that you don't need to live paycheck to paycheck. And I think how you do the very best with that is the stewardship we're called to have. I just think that you can do it. There's so much more people can do when we sit down with so many people. It's like, wow, we could really amplify this to be something significantly more intentional for what your goals are. And I get excited about that. Like I say, boy, I can really bring opportunity for this person where they don't see it. And that actually happened a week or so ago. I was sitting down with a couple, and the person was like, you know, I've been working 40 plus years, and I just don't think I have enough money to retire and accomplish our needs and do this. And so I went through from start to finish, and we worked on a plan, and they were like, wow, I can do this. I can't say that that's the way for everyone, but I would say that the majority of people who sit down with us, you know, I would just say have relief that there's more that they can do, right? I think there's just the, as you said, the mountaintop, Seth, and linking all these things together. They just don't know all the things that you can bring to the table in that facet.
Yeah, I think it's, you know, it's experience worth having, not to kind of toot our own horn here, but, you know, generally people, you know, I think in almost every instance, they feel better leaving than they came in, right?
Yeah.
So whether it's just a quick fact check or
Dan's humor.
Yeah, that's right. You get a couple laughs no matter what. But just going through the process of, you know, having a sounding board, sitting with somebody, reviewing your assets, going through your goals, and, you know, getting that kind of second opinion on, you know, whether or not there's enough here to make it all happen. I think can be just a tremendous relief for people. And and even if it's not the news exactly we're looking for, you're going to come out of here with a plan as to how to best get there. What's the best chances you have of making it?
We did something on a show a while back where it talked about when you did at least a review once a year versus quarterly, like all that stuff about the amount of health that you had.
Yeah.
And I remember, and I'm not going to quote this probably perfectly, but I remember that if an employer did a quarterly, I think it was a quarterly review on people's investments and so forth with the company, that the person's percentage of work or production time went up significantly, way more than the amount of time spent in the review. I thought that was a tremendous statistic because people spend so much time worrying about money. Money is just a worry.
I think that unknown space is worse off. I can just speak for myself, whatever kind of personal crisis it is that I'm going through or whatever thoughts are out there that are kind of nagging at me. It's always worse not knowing until you sit down, you figure it out, put pen to paper, kind of get a real view of what the reality is. There's just something relieving about that. Even if it's not great, you just have a direction to move in and you can kind of put aside all the worry.
Yeah. So, kind of with our topic today and just working through building and navigating generational wealth, one of the things that's really important for people to understand is that the majority of the wealth sits in the hands of the baby boomers. They have the vast majority. Up to 2030, it's predicted that they'll have about 45% of all the wealth among all generations. That's massive. The next largest generation is the Gen Xers, which will be, I would say, about 20% of the total wealth today. And that's continuing to grow. So they're spending theirs down. But what we've noticed, and we've talked about this a few times, guys, is the idea that for the last 30, 40 years of all the historical ways that baby boomers have made money, right? In those diversified portfolios, the large cap assets, the mid cap assets, the small cap, the allocation to the bonds, and kind of that whole diversified portfolio mix is the definition of every historical process of how you make money in the market, and we use that every day today looking forward. And our conversation today about building and navigating wealth is, if the baby boomers are making this change from the accumulation to that distribution phase, and they've accumulated it one way, how are they going to invest their money differently in the distribution phase? How are they going to create distribution, and how are they going to allocate it? And we've talked about this, that as people retire, and I think anyone who's listening who's either retired or going to retire, you're saying to yourself, what? As I hit those retirement years, I definitely want to take less risk, and I don't want to take more risk. And I need income. I want to create as much income as I possibly can, potentially, or at least stable income or predictable income. And that's not generally going to come with just straight up market holds.
That's a really good point. You get to the top of the mountain. Now what? I mean, have you ever gotten yourself in that situation where I think of rock climbing, where I just, was like, well, I'm going up. And then the next thing you know, I'm looking down. I'm like, that's a long way that I'm going to travel if I just let go. I better try to make sure that next step down is the right one. Anyways, maybe that works for you. Maybe it doesn't. But there's that accumulation and the distribution. And we're talking about like supply and demand, just simple supply and demand. Money creates and generates needs, and it has the generations have specific things that they're looking for. And I think of some of the things that are not right in front of us today, but just an example of like, well, what has this generation, the baby boomers, done historically? And one of them that, Ben, you brought this up, this is many moons ago, but it was the Lee Iacocca Chrysler story and the minivan. And I didn't realize that, but that was so true. That was a baby boomer phenomenon, that the minivan was created and it hit the market, and it was phenomenal what happened in that story for Chrysler, the turnaround, and it was baby boomer money. It was a baby boomer need. And now, well, they're not necessarily buying minivans.
They're buying sports cars, and that's what he did. I mean, he literally based every vehicle off of, kind of the age trends of what they were looking for and growing them in and out of the vehicle. Yep. It was pretty phenomenal that he had processed that. And I think we're saying the same thing in the investment world. And there's plenty of investment companies who are trying to answer these trends. There's a ton of different types of investments. I mean, we see the creation of investments, from ETFs to brokerage accounts to annuities I'm just thinking about all the random things that have been created. Pershing, our broker, the clearinghouse for our broker dealers, the largest clearinghouse in the world. They're owned by Bank of New York Mellon. They came out with FDIC coverage that covers an individual person up to $2.5 million, not $250,000, or $5 million for a joint couple. And I'm thinking to myself, total baby boomer answer for people who have garnered a ton of wealth and need to park cash and want to feel secure. We have created investment product after investment product after investment product, and yet people come out of retirement and they say, well, I'm just going to continue investing the way I was because it grew from there, and they don't understand that that's not how creating generational wealth and navigating that retirement years is really handled.
All right. Well, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And if you are out there in the podcast world, just hit the subscribe. Let us know, and we will send you some Money on Tap gear. If you're listening to us via radio, just head over to the podcast and subscribe. Get caught up on some shows that really are maybe tailored or specific for you. And we'd love an opportunity to connect with you here at Money on Tap. We'll be right back.
Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Group and our planners are here to help. Our team of experts will provide personalized advice tailored to your financial goals. Visit BrayshawFinancial.com today to schedule your free consultation. Brayshaw Financial, investing made easy.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are diving into building and navigating generational wealth. What we've been talking about is the greatest generation. Maybe that's debatable. I don't know. But it's the term that's out there, the boomers. You know what we're talking about.
I thought the Gen Xers were the greatest generation. What's going on here?
Yeah. So your generation is always the greatest generation. And right now, the greatest generation does happen to have the most wealth. So that's what we're talking about. And why are we speaking to this? Because it is good. There's going to be a great wealth transfer, and it's already happening. The things that we're discussing right now is current, trends, interests, supply and demand. That's the story. That's the story around the money. And that's how it's going to flow. Ben, you were talking about the investments that are tailored specifically to this idea of where the boomer money is heading.
Seth, what comes to mind to me, is just like, for instance, something as simple as like the iPhone. As all of a sudden everyone wants an iPhone. Everyone starts spending their money on it. You say
it's simple, but I'm still stuck on apps. I'm like, what in the world is this thing?
Well, everyone spends their money on an iPhone, and all of a sudden Apple goes up because Apple's taking in lots of revenue. And I think from the trend space, where are baby boomers spending their money? And I think, I would say that there's obviously, when you're going into retirement, you're looking at travel, you're looking at like having a good time. Maybe you're getting a second home and you're getting that fixed up. And, or something like that. I mean, it's honestly really, it's just all the kind of goal-oriented spending, like the cruise lines and the vacation spots and the Marriotts and the Hyatts and the, maybe Ritz-Carlton and so forth. But then, health and wellness, that's just been a massive expenditure. Some of those by choice and some not by choice. And with currently 45-ish, 50 million Americans or whatever the number is of retirees, in the next 70 or 80 million to come, the amount of money spent on these things is going to go up quite a bit.
Yeah, I mean, it's definitely a space that if you were an investor, beginning in the 60s and you just had this kind of unbelievable notion and just invested into the trends that this massive population of Americans would spend money on in the retail space, you would have done really well. And kind of getting prepared for this, understanding, the baby boomer generation, and just to give it a quick definition, that's babies born between 1946 and 1964. It was amazing what had happened in that time. In 1946, 3.4 million babies were born, and the following year, 20% more. And that continued until 1954, when baby boomers made up 40% of the United States population, or 1964 rather. So in just that period of time, they become almost half of the population here. And I thought it was interesting, so in 1946, 3.4 million babies were born. The population of America at that point was 141 million. Just to check it, last year I looked into it with a population now in the U.S. of 360 million plus. It was 3.6 million babies. So we're having the same amount of babies with almost a third of the population at this point, or 3 times. So it's an incredible trend that we went on that just expanded this country population-wise in incredible ways. But just by the sheer numbers of that, you can appreciate the impact that they've had on spending trends in the retail space and what it is that people buy. So these trends, for current investors, this is still something to get behind. This generation is still spending money and still affecting what happens in the retail world.
Yeah, a couple of examples that I think of are kind of in that leisure and travel. The Wanderlust Adventures, they are a travel company that they really recognize the desire among boomers for just a unique, and they call it unique and enriching experiences. Really what they do is they curate a specialized travel package that's catered to preferences of boomers. It's kind of a top to bottom, it's a vertical in this, where it's a very top to bottom, all encompassing approach to the boomer population and their what they're thinking and how they're wanting to explore and travel. And so they've tapped into the niche and they've experienced remarkable growth and profitability. By the way, this is not a recommendation, just an example. And another one is in the retirement communities, the Haven retirement living, or Serene Haven retirement living. What they did is they just saw this need for a demand for high quality retirement communities that provide comfortable, enriching lifestyle for boomers, and develop kind of the state-of-the-art retirement community with a focus on amenities, healthcare services, social activities, you name it. I was actually just in a meeting the other day with I'll call her a young lady. And in the background, she lives in one of these places in Southern California. In the background, she says, "Oh, please excuse the noise. It's the Beach Boys." And they actually had the Beach Boys giving a concert at their community. I love the Beach Boys. A 1-bedroom sounds fantastic. All things taken care of. I just plug and play and have the time of my life.
Yeah, it's incredible, these communities and how they've developed. And I know, I got a number of people that I work with that kind of frequent those and aspire to move into places like that, because they really are turnkey and they really do appreciate that generation and know how to kind of build their amenities and services based upon what they're looking for. But it's important for all boomers out there, or people that are retiring or in retirement, to take a couple of appropriate steps to make sure that can be as successful as possible. And one of the key things, particularly if you're still working and have an opportunity to get to work on this before you retire, is to take a look at a budget, now while you're still employed and what it looks like in retirement after that, because there'll be a few changes, obviously, when you retire that can affect what you spend. But one of the critical issues is to do your best to get out of debt before that day comes.
That could be a tall order. I would not say just get all your debt out and liquidate all your assets and pay it all down. Like, that's Danger Will Robinson. What's the guy that does the debt? Dave Ramsey. I've met people who have just taken that to the nth degree and liquidated 401ks, paid taxes, paid off a car. There's good ways and bad ways to pay down debt. And I think there's never wrong to pay down debt, but how you might do it might be more costly than it's worth. And a lot of people don't understand that. And I've seen people get hurt by that. And every situation in the starting point that you're at today, that's your new starting point today, where you're at, what your debt is, what your assets are. There's always a best way to do that. And I think, sitting down with somebody to do that is really valuable. But I am a pay down debt scenario. But at the same time, if you come into $100,000, Dan, and you have, a $300,000 mortgage that's at a 2.5% rate that you're locked in for 10 more years of payments, and you can go and buy a 4.5 or 5% CD, and you're not going to re-amortize that note at a 6 or 7% mortgage rate. There may be some counsel to be had of whether or not you pay that down, or just if you have enough control that you could put that in an account that is guaranteed to make more money and let it sit there for 10 years. You potentially have a better opportunity of entering retirement 10 years from now with more money paid down on that home.
Yeah, understanding what the cost of that debt is in terms of interest rate versus what other opportunities exist is something to definitely carefully consider before you just cut that check.
But most people don't have self-control. They see $100,000 in the bank and I can do anything with. But at the same time, if you lose your job and you've paid down your mortgage, and you can't pay your mortgage anymore, they're still going to take your house even if you paid it down $100,000. But if you have $100,000 sitting in the bank, you can pay your mortgage for 6 months while you're looking for another job too. So I think having assets around is important. The next piece, Dan, you make this point too all the time, is max out retirement. And I would say that which retirement you're maxing out is really important, whether it's a traditional IRA, a 401k, or a Roth component, a post-tax, that's going to grow tax-free and be tax-free for you in retirement, may or may not be the best direction for you.
Well, I'm always a big fan of that. Just working in the 401k space, I love to see people doing what they can to prepare themselves is really what that's about. I'm like, hey, you've got an opportunity, fill this bucket. And in all fairness, that's an opportunity that's not always going to be there. And there may be some other opportunities that we can convert or use down the road too. And just, shooting from the hip, folks, that's one of the things I just want to caution. We're having some very strong advice or recommendations here for you today. And the danger here, if you're doing this outside of a plan, you can really not align yourself with what you're going to need in the next 5-10 years, because it might just warm your heart to say, I'm going to go max out my retirement. But you might have forgotten some other things that we're talking about here today as well. Like, for instance, hey, let's create predictable income. And maybe there's a blend of contributing to that retirement plan and also pulling some money or putting some money aside in a different form. Maybe you want to start using some variable annuities with some, with some different purposes around that. There's all sorts of different vehicles in here. But when we start heading towards that predictable income, which happens to be where we started off talking about in the accumulation phase, and I've done the large cap and the mid cap and all those different, growth strategies. When we start talking about predictable income, if you have an engine, and I'm just going to call it an engine, it's your instrument or your investments that you've been growing from, those go up and down. And if you have an engine that's going up and down, how do you know that you're at the right time to go ahead and take income from that? Is that how it's a very challenging piece to work through if you're doing it yourself, even if you're a professional, monitoring that, pulling the right amount, putting it in the right place. It's not necessarily the most stable way to go. So predictability is huge. Yeah, Ben.
Yeah, no, I was just saying, as you're talking about this and predictability, it's like, I don't think we've been at a better time right now. Whether it's an annuity, variable, fixed, whatever, or whether it's a bond or a fixed income strategy or something, there is more opportunities right now today than there were a year ago or for the last, say, 10 years of fixed income strategies that have come about that have really created opportunity for people that a year ago or the last decade did not exist, because it was like people would come in and be like, I need guaranteed income. It's like, well, bonds are going backwards, and they're probably going to go further backwards as rates go up at some point. Now rates have gone up, and now new bonds are opportunistic, and old bonds are underwater. And so, there's just lots of things you can do, and it could be even CDs. There's 1,000 things under the sun. But, you were talking about all the different vehicles, these new Lee Iacocca kind of vehicles in the investment world, whether it's annuities, structured products, or bonds or CDs, they all have a competitive space now to really provide fixed income in a way that has been, I think, one of the strongest in history. And, what an opportunity for the entire baby boomer community to really embrace whichever one is good for them. Because, I know people have sat down and I'll never buy an annuity, or, bonds are just a waste of money. And it's like, these things are constantly moving, just like you were saying, Seth. But we could talk about that for 10 hours. What I would like
we have.
We probably have. So what I would like to do is just move to and ask Dan, from a budget strategy. We talk about retirement budgets, but I want to talk about yet to retire and retired. You want to chat a little bit about that?
Yeah, when you've yet to retire, and presuming it's a married couple, everybody's got jobs. There's a lot of kind of individual travel. So you're using two vehicles, you're filling two tanks, you're having different meals and situations because you're just unable to do all of that together. Whereas when you do ultimately retire, you think in practical senses you'll need one vehicle, you fill in one tank, you're probably eating together, probably spending more time at home for some of those meals. So it's fair to say that there will be a reduction in money spent on a regular basis. There might be more money spent on vacations and special occasions, but that day-to-day, week-to-week, monthly budget can probably reduce to a half or two-thirds.
Yeah, I would even say, that's included in the idea or the conversation of people say, well, I'm going to travel, so even though I'm going to have a reduction in that, I'll count for my traveling as that additional money. I usually see people like 5 days a week, they're having coffee on the balcony, or they're doing this or whatever, or they're working on the yard, and they just don't spend the money they were going to spend. And that's even after the trips. There's always that outlier, but the vast majority of people don't even spend half to two-thirds of their previous income, even though people say, I need you to provide me the same income because that's how I live. And they don't understand the amount of waste working and traveling and all that stuff does.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. When we come back, we're going to be talking about the wealth transfer to come. We'll be right back. Hey, Seth Krussman with Brayshaw Financial Group. Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Advisors, we're here to help you. Our team of experts will provide professional, personalized advice tailored to your financial goals. Visit BrayshawFinancial.com today and schedule your free consultation. Looking forward to seeing you there.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And I do want to just put out there one more time, if you're out there in the podcast world, thank you for the subscribes and thank you for dropping us a note, because we love hooking you up with Money on Tap gear. And if you're just foaming at the mouth and haven't figured out how to get over to the podcast world, just drop us a line, 855-226-8551, and we'll get you over there and also get you some Money on Tap gear. So we're going to be talking about wealth transfer to come, right? Here's where we're going with this, is that there's a lot of money coming down the pipe. People are going to be passing away. That's the transfer and the inevitability. Oh, that was almost as bad as anonymity, but all right, it's going to happen, guys, and people are going to pass away, and when they do, there's going to be transfer, and that's what we're talking about. So, what can people do in that preparation?
Seth, you're the only person can talk about someone passing away, and I feel good about that.
Is that what you've kept me around all this time? Oh, that's nice. I feel like I'm going to do the bright and shiny. Don't look here. All right, so we're going to talk about, guess what? Our favorite, life insurance, right? Why would this be important? I'm hoping that you already know, but we're going to go ahead and dive in and just grab a couple things here for you. We want to make sure you have something to bring back to that coffee table and have a good conversation tonight.
Yeah, I think we chatted about this a couple different ways, but I mean, my grandfather was like a debit collector. I mean, that's like, for anyone listening that knows what that is, it's like they go around to your house and collect a nickel or a dime to pay for your life insurance. I mean, that's what they did. And they would, turn it in. So just crazy that that he did that. And there's probably people listening to our show today like, I remember that time. And it's just interesting. But life insurance has been a generational caring event. I think life insurance has kind of gotten a bad name over the last 100 years or 50 years or whatever, because, a number of ethnic groups, I mean, whether you were, Italian, Irish, Jewish, I don't know, Armenian, whatever it was that you came into America, you would start getting a job and you'd buy life insurance. It was like a standard because the entire purpose was to help the next generation, to give them the next leg up, because you did the whole you lived in poverty, but you paid your life insurance. And it was just an interesting time for what life insurance is. And now it's kind of seen as a financial burden. Like, why would I do that? I don't really need to provide for my kids because I have all this wealth. And a lot of people who are listening, I mean, I've had so many people come in the office and say, I don't know that I have enough money to retire. Some of them have 50,000, some have, 5 million. I mean, it's just crazy. People have all sorts of perspectives on what their wealth means to them. And a lot of them may spend this money down. So people say, well, what's wealth transfer? A lot of people forget that the largest portion of the wealth transfer space is real estate, right? I mean, it's your home. Like, you spend all your retirement money down and so forth and whatever, and then your kids get this, what was a $500,000 home maybe, and now it's $1 million. Maybe it's $1.5 million in 20 years or whatever. We've seen real estate just skyrocket. And people don't realize that the wealth transfer is attached to everyone just with their primary residence. I just think that's funny that people miss that.
Yeah, the notion of insurance can be kind of twofold, right? So there's obviously the death benefit, but it can offset a tax obligation on other assets, right? So if you want to pass on a business or a lot of real estate holdings, that's an easy tool to use to help offset what might be lost in taxes. And as well for families that have multiple kids and multiple generations to take care of, where it's hard to divide the house 5 or 6 different ways when somebody wants to stay there. Well, you can use insurance to offer cash to your beneficiaries who won't stay in the house, who live someplace else in the country, but you want to treat them fairly or in some sense equally. Well, insurance can be the offset to that as well. It's just a very flexible tool to be used that passes on tax-free wealth on your death, and it allows you to direct who it goes to, determine what amount is going to be received, so that you can set up those next generations to have benefits from your hard years of working, and put them in a good position to go forward and take care of those that follow them down the road.
Yeah, I think a lot of people just forget the fact that life insurance is a tax-free benefit to whoever inherits it. When you inherit these IRAs, I mean, one of the things, I think Seth does a great job about communicating this too, is and not that you don't, Dan. I'm just thinking about Seth. We were chatting about this just the other day that, if you leave your IRA to your children, they could be inheriting it at 1950s tax levels of 60, 70, 80, 90% taxes. And it could just literally wipe all that money away. And we were talking with a client last 3-4 weeks ago, just saying, yeah, I know you're not required to take minimum distributions, but let's start taking IRA distributions now, because we know exactly what tax bracket you're in. With $14 trillion of new national debt, we don't know where the tax brackets are going.
Yeah, another one of the things I love is the conversion of an IRA into a Roth IRA in that early retirement zone. A lot of the time people aren't needing that income at that time, or the income has come down into another tax bracket. And so there's an opportunity that often gets missed in that, as well as step up in cost basis. That's another area of opportunity that gets missed out on a lot. Folks, you have been listening to Money on Tap. And you know what? Hopefully you've heard part of your story here today. We've covered a lot of ground. Eventually, we're all in this time zone, or in this path of wealth transfer. And it's just wonderful to come alongside and take opportunities like this to learn about it, to find out what our personal journey is, what we would like that expression to be, and to start crafting that. We love spending time with you here. Be successful in your investing, and we can't wait to see you next week. You listen to Money on Tap.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.